probably heard it 1,000 times. The age-old advice to save and invest diligently. They told you to put your hard-earned money in the stock market. Maybe even throw it all into the S&P 500 or those giant, reliable, large-cap companies.
An index fund, which is a great way to invest.
Index investing, based on the research that has been done, outperforms 80 to 85% of active managers over a 15-year period of time.
10 years, or buying the S&P 500 and holding it for 10 years, I'd buy the S&P in a second.
Standard & Poor's 500. They took the 500 largest U.S. companies and they make that index on it. And that index, that has outperformed, going back to 1871, 95% of the investment professionals.
Outperform the market. You don't want an index fund. That's guaranteed mediocrity. But in fact, the data show that in fact it's superior investing.
If you research out 30 years, the number of active managers who can outperform the index is less than 1%. That's statistically zero.
Set up an IRA account, set up some kind of retirement account, and you just invest in the S&P 500 index. All right, now,
those were the good old days when the market could churn out a sweet 10% average annual return. But those days are long gone. The stock market now sits pretty at the pinnacle of its S-curve in terms of adoption. The days of relying on the stock market, especially index funds, to deliver that 10% return are a distant memory. The shifting demographics and the ruthless economics of our modern world have shattered that once reliable mechanism. Stocks no longer dance to the tune of their issuing companies' profitability. The S&P 500 and large cap stocks have taken a wild detour from their true value. It's likely they've gone on a reckless joyride, leaving investors baffled in their wake. For instance, the company Workday had a whopping 1,600 price-to-earnings ratio. But why? What makes this company worth 1,600 times what it earns? Here's the truth. Stocks aren't soaring because they're fundamentally sound. These assets only increase in price due to the brute force of 401ks, 403bs, pensions, and IRA contributions. These are what's inflating their numbers. We're talking about a colossal $20 trillion in the stock market that is there purely by force. This is because stocks are mostly all that retirement plans are allowed to invest in. In 1974, ERISA was signed into law, which forced retirement assets into the stock market. You can't invest your retirement money in real estate, crypto, or even your own business. So that money had to go somewhere. The result now is that the stock market prices are far departed from the underlying stock's value and company profitability. It has over $20 trillion that otherwise wouldn't be there. The money keeps pouring in weekly with each remittance from payrolls and employee retirement savings contributions. And who's absorbing it all? The large cap stocks. They are the ones large enough to absorb all this new money, like cosmic vacuum cleaners slurping up every penny thrown their way. But there's more to this tale. As labor force participation wanes, fewer folks are automatically enrolled in retirement plans that feed the stock market. The flow of money starts to trickle, the market's lifeblood getting thinner by the day. Picture this, the baton being passed, but to a smaller and smaller team. With each generation, the inflow of money pales in comparison to the outgoing stream. Just look at the baby boomers compared to Gen Z. It's like comparing a tidal wave to a ripple. Less new money goes in from new people entering the workforce, and consequently entering the stock market with their retirement plans. But more money is withdrawn from it as retirees start cashing in their investments to live on in retirement. To make matters worse, The Federal Reserve has been on a money printing spree. Those new dollar bills added to the economy easily end up in the large cap stocks, pushing them higher and higher above their true value, because these large caps are big enough to absorb them. What's truly troubling is that these gains that the stock market is making are really phantom gains at best. If the market goes up 10%, but inflation that same year was also 10% because the money supply was increased, there was no legitimate gain. Like running on a treadmill, no progress was made, just a constant struggle against the declining purchasing power of your dollars. So what do you do now? The key to success in this unpredictable landscape isn't blindly trusting those big shots who've already made it. These investments have already proven themselves. The trick is to invest in what has the lowest price with the highest likelihood of going up. These are investments in things yet to prove themselves. You can't rely on large cap stocks anymore, but there are still opportunities in small cap and mid cap stocks. What you must know is how to analyze them. There's also a whole other world out there, crypto assets. While cryptocurrencies are the wild stallions of the financial realm, they've got their own cycles, their ups, their downs. If you get in tune with their rhythm, if you understand their cycle, true generational, life-changing wealth can be made with them. And there are still opportunities in real estate and entrepreneurial endeavors. These are the things that will set you financially free, like the stock market once had for generations prior, but no longer does today. And this channel, Net Worth Rising, will show you how to do all of this. So do your future self a favor and subscribe to the channel. Also, do your family and friends a favor and share this with them.